Evergrande collapsed, then Country Garden, then 50 more real estate companies. This is how economic systems die. In August 2021, Evergrande, China's largest real estate developer, announced it could no longer service its $300 billion debt. Wall Street was concerned, but the Chinese government insisted the situation was under control. An isolated incident, they said. Markets dipped, then recovered. 18 months later, Country Garden, China's second-largest developer, met the same fate. Another $300 billion in debt. Another default. But this time, nobody believed the isolated incident narrative, because in between, more than 50 major real estate developers had collapsed. Shimao Group, Fantasia Holdings, Modern Land, the list kept growing. This wasn't just a real estate crisis. This was the first sign that the foundations of the world's second-largest economy were cracking. For over 20 years, Western economists have been predicting China's collapse. Gordon Chang's 2001 book forecasted collapse by 2011. Wrong? After 2008, analysts claimed China's credit model was unsustainable. Wrong again. In 2015, the stock market crashed 40%. Still wrong. So when people say China is collapsing today, there's understandable skepticism. It's become the boy who cried wolf. But this time, the numbers don't lie. China is facing the same crisis Japan experienced in the 1990s, only vastly larger. And if the collapse happens, the consequences will be global. Evergrande's fall wasn't an accident. It was the logical conclusion of 40 years of policy decisions. The story begins with Deng Xiaoping opening China to the world in the 1980s. Between 1990 and 2020, 800 million people were lifted out of poverty. GDP grew at 10% annually for 40 years. But the engine of this growth wasn't manufacturing, it was real estate. The Chinese government viewed housing construction as the primary economic driver. Construction demands steel, cement, glass. It creates employment, and homeownership keeps the middle class content. This model worked brilliantly until it didn't. By the 2000s, housing prices were rising rapidly. Families invested in homes because it was the safest asset class. The average urban household holds 70% of its wealth in real estate. For comparison, in America, that's 35%. This turned housing into a speculative bubble, people buying not to live in, but to sell at higher prices later. Developers like Evergrande responded by borrowing heavily. Their business model was simple: buy land cheaply from local governments, pre-sell apartments before building them. Use that money to fund construction. Repeat. It resembled a Ponzi scheme. New projects financed old ones. This worked as long as prices kept rising. But in 2020, the government introduced the 3 red lines, rules limiting developer debt. The intention was to stabilize the market. Instead, it triggered collapse. Companies like Evergrande were already over those limits. When they couldn't borrow new money, they couldn't pay old debts. Pre-sales dried up. Projects stopped mid-construction. Evergrande alone had 1.6 million unfinished apartments. Families lost life savings. Mortgage boycotts began. Banks panicked, and local governments panicked most of all. Here's where it gets much bigger than real estate. China's local governments have a fundamental problem. They hold 80% of spending responsibilities, but collect only 50% of tax revenues. The central government controls income and corporate taxes. Local governments must pay for schools, hospitals, infrastructure, but lack the money. Their solution? Land sales. Local governments sell 70-year land usage rights to developers. When the property market collapsed, land values fell. Developers stopped buying. Local government revenue evaporated. They still have spending obligations, but no revenue. So they borrowed through off-balance sheet companies called local government financing vehicles. Total LGFV debt now exceeds 60 trillion yuan, $9 trillion, 50% of China's GDP. Many can't even pay interest anymore. They're borrowing more to make payments, a debt spiral. If local governments collapse, banks lose. If banks collapse, the system fails. But there's something worse lurking beneath. The real estate crisis and government debt aren't standalone problems. They're symptoms of China's deepest issue, demographic collapse. In 2022, China reported its first population decline in 60 years. Birth rates are at 1.09 children per woman, lower than Japan at its worst. Experts project the population could fall from 1.4 billion to 600 million by 2100. Why does this matter? Economic growth depends on more workers or more productive workers. China no longer has the first, and productivity growth is slowing. By 2035, 30% of the population will be over 60, one retiree for every 3 workers. Pension systems are already strained. China is getting old before it gets rich. Japan got rich first, then dealt with aging. China doesn't have that luxury. The younger generation knows it. Youth unemployment officially hit 21% in 2023. Then the government stopped publishing data. The real figure is probably higher. The lying flat movement emerged. Young people opting out entirely. Marriage rates are falling, birth rates collapsing, consumer spending stagnant. This threatens China's social contract. No political freedom, but economic progress. If progress stops, the contract breaks. And progress is stopping. China is now in deflation. Prices are falling. This triggers a vicious cycle. If prices fall tomorrow, why buy today? People delay spending. Companies produce less. They lay off workers. Unemployment rises. Less spending follows. Deflation feeds on itself. Japan fell into this trap in the 1990s. The lost decades. China is following the same path. Property prices falling, consumer prices falling, wages stagnant. People save instead of spend, making the economy worse. The central bank cuts interest rates, but like Japan, it has little effect. Nobody borrows because the future is uncertain. Companies don't invest because demand is weak. Xi Jinping's policies made things worse. In 2021, he cracked down on tech, fining Alibaba, Tencent, Didi billions. Foreign capital fled, innovation slowed. Then came zero COVID. Harsh lockdowns through 2022 disrupted supply chains and crushed consumer confidence. Global companies began relocating to Vietnam, India, Mexico. Foreign policy didn't help. Wolf warrior diplomacy strained relations worldwide. America blocked semiconductor exports. China's technological progress slowed. The Japan comparison is chilling. In the 1980s, Japan was the world's most dynamic economy. The land under Tokyo's Imperial Palace was supposedly worth more than all California real estate. Then the bubble burst. Banks collapsed. The government responded slowly. Result? 30 years of stagnation. China is making the same mistakes. The bubble burst. Banks are strained. The government intervenes, but not fast enough. Deflation began. Demographics declined. Unlike Japan, China got old before getting rich, meaning far less fiscal space to maneuver. If China follows Japan's path, consequences will be global. China is 18% of the world economy, the biggest engine of global trade, the biggest buyer of commodities. If Chinese growth stops, Australia, Brazil, Germany, South Korea all suffer. Chinese bank failures would ripple through global finance. 3 scenarios lie ahead. Best case, aggressive reforms, restructure local debt, stabilize property, boost consumption, reverse demographics, revitalize tech, win back investors. Growth slows to 3–4%, but collapse is avoided. Middle case, current trend continues. Japan's path. Property stays collapsed. Deflation sets in. Growth below 2%. High youth unemployment. Social unrest increases, but the regime survives. China remains large, but no longer rising. Worst case, financial crisis spirals. Banks fail. Mass layoffs. Widespread protests. Regime turns to nationalism and repression. Military aggression toward Taiwan. Global recession. Supply chain collapse. Second Cold War. Right now, we're heading toward the middle scenario. China's economy isn't collapsing, it's slowing, but slowdowns can accelerate. Dominoes are hard to stop once they start falling. Evergrande collapsed. Country Garden collapsed. 50 more companies collapsed. Local governments drowning. Banks strained. Demographics declining. Deflation setting in. Youth despondent. This is how economic systems die. Not suddenly, but like dominoes. The question isn't, will China collapse? It's how fast and how bad. And is the rest of the world ready? Because history teaches us, when an economy is this large and this indebted, collapse is never isolated. The dominoes always fall. We just don't know how long it takes and who they take down.